If you're an S-Corp owner, your salary is probably wrong. Not because you're doing anything dishonest, but because most people either set it based on a rule of thumb or based on what their CPA suggested years ago without really walking through the math. And getting it wrong in either direction costs you money. Pay yourself too much, you're overpaying payroll taxes. Pay yourself too little, you're inviting IRS scrutiny and capping your retirement plan contributions. In this video, we're going to walk through what reasonable compensation actually means, how to think about the right number, and why your salary directly affects your retirement plan options. I'm Matt Losanno with Cinder Wealth. Quick disclaimer, this is educational only. S-Corp compensation is a complex topic that depends on your specific business, industry, and situation. Always consult your CPA before changing your salary structure. Let's start with why this matters. When you're an S-Corp owner, working in your business, the IRS requires you to pay yourself a reasonable salary for the work you do. That salary is subject to payroll taxes, Social Security, and Medicare, which combined run about 15.3% up to the Social Security wage base, and then 2.9% above that. Now, here's the valuable part of the S-Corp structure. Anything above your salary that the business distributes to you as a shareholder distribution is generally not subject to payroll taxes. So, let's say your business nets $400,000. If you pay yourself a $100,000 salary and take $300,000 as distributions, you're only paying payroll taxes on $100,000 instead of $400,000. That's a huge tax savings. But here's where people get in trouble on both sides. If your salary is too low, say you're netting $400,000 and you pay yourself $30,000, the IRS will likely flag that as unreasonable. You're clearly avoiding payroll taxes on income that should be classified as compensation. That's an audit risk. If your salary is too high, say you're paying yourself $350,000 of that $400,000, you're limiting most of the S-Corp advantage. You're overpaying payroll taxes on income you could have taken as an owner distribution. The goal is finding a defensible middle ground. The IRS standard is reasonable compensation, which sounds vague, but there's actually a framework for thinking about it. The question the IRS asks is, what would you have to pay someone to do what you do in the business? If you're a consultant charging $300 an hour and your business generates $600,000 per year, your compensation should reflect the market rate for someone performing your role, not $30,000 a year. A few factors that go into determining reasonable compensation. What similar roles pay in your industry and geography, the size and complexity of your business, your training, experience, and qualifications, the hours you work in the business, what your business would have to pay an outside contractor to replace you. There's no single magic formula, but there are resources. The IRS has published guidance on this, and there are compensation databases your CPA can reference. Some CPAs will do a formal reasonable compensation analysis, especially if you're making significant distributions. For most owner-operators, a rough starting point is somewhere between 40 and 60% of business net income, with adjustments based on the factors above. But that's a starting point for conversation, not a rule. Here's what most S-Corp owners don't realize, and this is where it gets really important. Your retirement plan contributions are calculated based on your W-2 salary, not your total distributions, not your total business income, your W-2. So if you pay yourself a $50,000 salary, your employee 401k contribution is capped based on that. Your employer profit sharing contribution is based on 25% of your W-2 compensation. Your cash balance plan also is salary based. This means a salary that's too low doesn't just invite IRS scrutiny, it caps your retirement plan contributions and reduces your tax deferral opportunities. Let's look at two scenarios at the same total income. $400,000 in net profit. Scenario A, you pay yourself a $100,000 salary and take $300,000 in distributions. The employee 401k contribution is up to $24,500 and the employer contribution up to 25% of $100,000 or $25,000. So the total potential is almost $50,000. Scenario B, you pay yourself $200,000 salary and take $200,000 in distributions. The employee 401 contribution is the same at $24,500 and the employer contribution of 25% of $200,000 is now $50,000. So bringing up your potential 401k contribution to the max of $72,000. Same business income, but scenario B gives you $20,000 more in retirement plan contributions just by adjusting the salary, and those contributions are tax deductible. Now, Add a cash balance plan on top, and a salary base matters even more. So how do you actually figure out the right salary? Here's the process I recommend walking through with your CPA. Step 1, get a market rate benchmark. What would you pay someone with your skills and experience to do your job? Use industry salary databases, job postings, or formal compensation analysis. This is your anchor. Step 2, model the payroll tax impact. Calculate what you save in payroll taxes at different salary levels. Your CPA can run this in about 15 minutes. Step 3, model the retirement plan impact. At each salary level, how much you can contribute to your 401k and any cash balance plan. Higher salary equals more retirement contributions, which equal more tax deferral. Step 4, find the crossover point. There's a salary level where the additional payroll taxes from a higher salary are more than offset by the additional retirement plan deductions. That's usually the right target. Step 5, document your reasoning. If the IRS ever questions your salary, you want a paper trail showing you applied a reasonable methodology, not just a number you picked. This isn't a set it and forget it exercise either. If your business income changes significantly, your salary should probably be revisited. Same if you add a cash balance plan or change your retirement plan structure. Here's what I want you to take away. Your S-Corp salary isn't just a compliance decision. It's a tax planning lever. Done right, it reduces payroll taxes, supports your retirement plan, and keeps you out of trouble with the IRS. Done wrong, in either direction, it either attracts audit risk or leaves tax deferral on the table. If you set your salary years ago and haven't revisited it, or if you're running on a rule of thumb rather than a real analysis, that's worth a conversation with your CPA. Subscribe for more content on tax strategy and retirement planning for business owners. This video is for educational purposes only. S-Corp compensation is complex and fact-specific. Work with your CPA to determine the right salary structure for your situation. This is not personalized advice. Thanks for watching.